Global equity markets have stabilized following Black Monday, and gold is falling from its 6-week high it hit on Monday. But our next guest says the precious metal may have the potential to hit its January high near 1,300. Mike McGlone of ETF Securities joins us now in studio. Mike, thanks so much for being with us.
Thanks for having me back.
So gold back down after hitting a 6-week high. Let's look at its movement right now, Mike.
Well, Monday's movement was a bit disappointing as the stock market collapsed.
Right.
And it's come back. But I think gold somewhat expected that. Also, the bond market's movement was somewhat disappointing. But I think in the bigger picture, the market's put in a pretty significant bottom here in July. It's just a question if it can work from that foundation, go test the upper end of the range. And I think it's more likely to do that.
But, well, you said it could hit 1,300, but what would be the drivers behind that?
Well, 1,300 was the upper end of the range. It's where we were in July. And the drivers are, first of all, we have a pretty solid foundation. A lot of that's being supported by this backwardation in the futures market. It's very rare, so that's an indication of a good bottom. It was way oversold. And what would drive it is a potential shift in what's been the bearish factors for gold. And that shift would probably come from the equity market. It had this long period of excessive returns and very low volatility. That's probably over. It's probably going to change. It's been really repressed by Fed tightening expectations. That's probably over. We'll see how far that goes. And it's also been really pressured by the stronger dollar. All that probably has shifted to either a flat market, and something might even shift the other way.
Well, you mentioned it. You were a bit disappointed by gold on Monday. Many people were after the Dow took a nosedive. Gold unable to breach through that 200-day moving average. What do you think happened to gold? How did it lose some steam here?
Well, sometimes we just have to make it as difficult as possible for those who are bullish. So 200-day moving average, good resistance. It held. See how long it holds. It might go test 1,100 again, but I think gold's on its way to just rotate back to the upper end of the range. It just needs to see if these key drivers will repress it back again. And I think those key drivers that we just mentioned are probably over.
Well, okay, let's take a look at the strength of the U.S. dollar. You think we've topped here?
Well, in March, when the dollar index printed 100, it was the most excessive move relative to its 50-day moving average, 52-week moving average since like 1981. So that's way overdone. And part of the dollar strength, we all know it's U.S. economic growth, but a lot of it is all this Fed tightening that's priced in the forward part of the futures curve. That keeps coming out. So dollar strength, Fed tightening, highly related. U.S. stock market strength, highly related. As that goes away, which it has been, the dollar's likely to trade in a range and might even come back a little bit and mean revert back to more of a normal range and maybe continue what it's been doing since March. And that's actually, since March, it's been trending down.
Well, yesterday, a lot of people were saying, look, the Fed should be paying more attention to what's happening in the stock market. Do you think they do?
Absolutely. Let's just look at the examples in history. Every single time we've had stock market crashes or big movements lower in the price of the equity market, the Fed has almost always been there to tighten. I'm sorry, to ease, certainly for the last 20 years. So they might say at this stage right now, they say they're worried about excessive risk taking. So they have to be very careful supporting the market like they've done in the past, which is a bit of a negative factor for equities, but absolutely, because there's few better indications of future economic growth or potential the opposite than the U.S. and then the equity market. And the Fed will never ignore any solid signal like that.
Now, Mike, just to wrap, you mentioned $1,300 gold, but where's the next stop for you? Where's it headed next?
The next stop, well, the first resistance is 1,200. You mentioned the 200-day moving average, but 1,200 has been basically the mean, median, and mode for the last 3 years. So it's got to hang out from that level. And I don't like to say, well, if it gets through 1,200, it's going to go 1,300, because I don't like saying if it goes up, it's going to go up. I'd rather just say it's more likely to test the upper end in the range after it really seemed to fail at the lower end of the range. And I think when it did that, it took a lot of those weaker longs out of the market, and it's more likely to continue to revert higher.
But to hit the 1,300, in what time frame would that need to happen in?
So
6 months? Or?
Probably 6 months, maybe this year. A lot of it's going to depend on those other factors. We'll see how that works out. But let's put it this way. If the equity market blasts off and Fed tightening comes back in and the VIX drops to 12 again, that wouldn't be good, and that's unlikely.
Mike, thanks so much for stopping by.
Thanks for having me.
And thanks for watching our Gold Report. We'll have Frank Holmes of U.S. Global Investors next.